Are you still putting off home buying? And are you waiting because interest rates are too high and home values have increased? It's been a long 2 years since the rates almost doubled. In January of 2022, interest rates doubled, y'all. Like, it is crazy. A lot of people I hear every day, they're like, yep, I'm tired of waiting. You want to tune in today because I'm going to give you some information that could change what you might have planned for 2025. So you want to stay tuned. We are going to talk about, will it get better? Where are the interest rates going to go? Will there be a bubble? Are the values going to decrease anymore? We've seen kind of a plateau, but we haven't seen a really huge downtick. But what's going to happen in 2025? So I'm going to let you know what predictions are happening. You know what the right choice is for you. So I'm Jen. I've been a lender for 29 years, and my superpower is that I've seen this happen before. And that's why I'm equipped to teach you on this topic. Okay, so I've gathered lots of data for you today. First, we're going to look at renters versus owners. I'm talking to both of you today. If you're a renter, first-time buyer, you're going to get some information that we've got today. And if you're a current homeowner, we're going to get some information for you too. Every single day, I hear the struggle between my current clients, homeowners saying, I am waiting for rates to come down so that I can go to another house. And I hear buyers that are new to the market saying, I'm waiting for rates to go down. I'm waiting for prices to go down. Affordability, y'all, it's all over the news. Affordability is at an all-time high. That's some good news for you. And I'd love to know, are you a homeowner or are you a renter? So I'd love to hear your comments, your questions. So feel free to comment anytime during this. So one of my current clients, Angie, who we've got actually right now, she is one of those people that's struggling between price, affordability, monthly payment. She already owns a home with her husband, and she's buying something for her elderly parents. Is so important to her. She's like, I can only afford so much. This is what the prices are, and I can only afford so much out of pocket. That is many, many people. I hear you. I deal with it every single day. I've got some solutions today, or at least some knowledge to help you know, like, what's right for me? What should I do in 2025? Consumer debt is at record levels, y'all. We've got debt is climbing into the well, not only the US debt, that's at trillions of dollars, but homeowners, non-homeowners, everybody have been putting stuff on credit cards. I read a stat just last month that eggs are up 34%. I mean, everybody eats eggs. Come on, let's go. These are basic things. What have you noticed going up in this last year? Let me hear your thoughts about, for you, what's going on? What's going up for you? For me, lots of our household stuff. And I've got someone in college right now. Diego, hey, I hope you're tuning in. Those expenses are definitely going up, y'all. I hear you. Pilly commented, chicken coops at home might be a good business. Pilly, that is true. Actually, my husband really wants chickens. I'm like, bro, later. We're not getting chickens right now. No wonder why current homeowners are holding on to their current homes. Y'all, that is an issue. That's why we're having low inventory right now. I want to show y'all some really interesting stats. 57% of Americans have interest rates under 4%. So this is really important for y'all to understand, whether you're an owner or not. This mentality, mindset of what everyone is going through, I hear this every week. I hear people that call me and say, I need to move, or I need to refi, I need to pay off debt, but I don't want to let go of my 3.2 interest rate. I mean, I hear you. 67.4 Americans have 50% equity in their home. Now, this is going to tie into what we're going to talk about in just a few minutes. We're going to be talking about the struggle between values and, do I sell? Do I not? Do I let go of my 3%? Like, what do I do? I had so much fun nerding out on slides today. I really think visuals are really important. As we're going through all of this, it's important for you to understand what's going on and how does this apply to me. Check this out. Average APRs on credit cards is going up. So where you may have been paying 14% interest on a credit card, Now, over the past couple years, as credit card is increasing, as the Federal Reserve interest rate rises, things follow. The mortgage rates followed, your home equity loans followed, your credit card interest rates, your car interest rates, those all followed. And so, as you can see in 2023, this doesn't even have 2024 numbers, the average credit card interest rate was 22.8%. This all goes to prove a very important point that I want to make to y'all. If you're a seller out there and you're thinking, okay, I'm holding on to my 3% rate, why would I sell? I want you to just think, how much equity do I have in my house? Let's be clear. COVID, the gift of COVID, if we had to find one, was all the appreciation that homeowners got in their homes that they should have never gotten. 2021 and 20 values increased more than they ever should have. So that is a bonus. And at that, you got a low interest rate if you bought in those times. But should you sell and cash in on this equity and put it towards a new home or pay off some debt? We've got some clients that are selling and they're saying, hey, I'm netting 100,000. I'm going to pay off 30,000 in debt and use the remaining 70 for my new home purchase. And they're wiping out that debt. Some people are doing that. Or they're taking the whole chunk and they're putting it towards the new house, which will then lower their payment. So you really have to just kind of weigh the pros and the cons. Renters, why this is important for you is because when these sellers start to make movements and start moving on with their lives and selling these homes, there's going to be more inventory on the market. This shows you how home prices have gone up. And I really like the way this graph shows around the country, how different segments of the country, because, you know, people move in segments, okay, to different states because of whether it's weather, whether it's where the job creation is created. So renters, now I'm talking to you. You're waiting for interest rates to come down. I get it. You're sitting on the sidelines. You're also seeing interest rates or home values have slowly crept up. Things have started to plateau, which is good, but they're still up. Like, they're not going backwards. They already went up the last couple years, and now they're kind of like this. They're kind of slowly increasing at normal pre-COVID rates. I do want to show you, renters, what you're potentially missing out on. The net worth between renters and buyers. So the red area down at the bottom where the numbers are super small, 2024, it's estimated that the average renter has a net worth of $10,000. Average homeowner has a net worth of $415,000. This is between their 401ks, including home equity. So where we talked about those sites before, we saw that I popped up on the screen where current homeowners have gotten the give a lifetime with increased values over the last few years. Well, this is where we can see it right here. There's you, the renters down there. And I hear every day, I'm sick of renting. I'm sick of making a landlord, wealthy. I hear you. You're sitting on the sidelines waiting for these things to happen. So that's why I think the 2025 information is so important. Say, how is this going to affect me getting off the sidelines and buying a home this year? This is the current storm that we're in. Everybody's waiting for something. Sellers are waiting for rates to come down so they can have a lower payment. Buyers are waiting. Meanwhile, life is going on and things are continuing to change. So the 2025 projections are coming up, I promise. Next thing that we want to see is how values are stabilizing. And again, this is going to help us understand what these projections are. So values are stabilizing. This is from NAR, National Association of Realtors. Existing home sales are a little bit down. Okay, so existing sales are down. Days on the market has increased. Now, I want to give this one some context here. This is really important. So you hear these things in the news like, oh my gosh, days on the market is increasing 58 days. Y'all, that's 2 months. And a balanced market, meaning it's not a buyer's market, it's not a seller's market. Like, over time, remember, I've done this for 29 years. I've seen lots of cycles. I've seen sellers markets and I've seen buyers markets. And 6 months on the market is kind of normal. And we're still at 2 months, and people are crying thinking, "Oh my god, that's such a long time," because we've been spoiled by what happened in 2021. It's still a really recent memory of all of the craziness that happened and the house is just flying off the market. So people think, "Oh my gosh, my house isn't selling in 2 weeks. What's going on?" But 58 days is still really low, y'all. But good news for buyers. So this is good for buyers that it's allowing prices to cool a little bit, and sellers are starting to come down a little bit on their prices. So the other thing I want to show you is that because of all this, that means inventory has risen a little bit. Things are on the market a little longer. There are some sellers also that are getting in the market because they're like, listen, I mean, we got to move. I've got 4 kids now. In fact, I had a past client call me the other day, Jennifer, I have 2.875 that you got me 4 years ago. I don't care because I've got 4 kids now. We've been super busy. I've got 4 kids now, and we're in a 3-bedroom house, this little bungalow. I got them in a cool historical area in Houston. They need to go. They need to get out of town. So not out of town, but out of that area. Okay. They need to get somewhere else. So, people have to move on. What does this mean for you? This means that things are stabilizing, days on the market, inventory's rising, prices are stabilizing, buyers, any buyers. This is some good news because it means that prices are kind of stabilizing so that prices aren't going to go up as fast as they were going up before. So right now is really actually a good time, regardless of the interest rates. It might be a good time to get in at something. Prices are moderating. This is over time. Prices kind of going up. You can see from 22 down to 23 of this on the far right here. The prices from 22 have come down a little bit, and now we're actually seeing them really, really stabilize. Okay, so here is a better graph for you as we were kind of flat earlier in the year, and now things have gone up a little bit, and now they're kind of just flattening out. That's great for buyers entering the market. The other cool thing that is good for buyers is that wages are increasing. This is good because increased wages helps us pay for those eggs that are 34% more. It helps you have more disposable income to afford the monthly payment on the higher house. So the economists, we want wages to go up. You can see the green areas, the green states, in fact, my state of Texas is one of them, has pretty high payroll job gains. This is good news, y'all. So around the country, you can see these spots. So the green and then the darker blue, you can see kind of central US is where these job gains are happening. Wages are increasing, and I think that is the most important thing, which is going to really affect housing and buyers getting back into the market. Okay, and sellers as well, because sellers are going to be able to afford, these higher prices. When they sell, they have to go somewhere, right? Let's talk about this big bubble. You're talking about all this stuff. There is a percentage of people that are still waiting for this housing bubble. I do not buy into it. I am on the other side of the camp that thinks that the bubble is not going to happen. I've been hearing about the bubble since 23, 24. The bubble has not happened. In fact, I'm going to show you some pretty interesting stats that I think support, at least currently, that the bubble is not happening. Bill McBride, who's an analyst with Calculated Risk, smart guy. With the recent home price increases, some people are worried about the new housing bubble, but mortgage debt isn't a concern, and lending standards are much better now than during the housing bubble. What does this mean that now things are better than the housing bubble? So the last bubble that we had, I remember it very vividly. And in 2008, we had completely different conditions than we do now. We had people breathing and they got a mortgage. Like literally, it was like that. The standards were very laxed. It was really out of control. When that all burst and all these investors that have these groups of mortgages figured out that they weren't performing because people were adjusting and they were over leveraged and all these weird things happened. And that caused this housing bubble. This is what's different now. Back then in 2008, there was a lot of supply. There was 10 months of supply when this happened. Now there's four months of supply. Back then, and I'm having trouble reading this myself. Oh, newly built homes, there were 1.6 million. And now the new homes roughly a million. So inventory is down. Back then there was over inventory. That's what a bubble is when you've got all this inventory and all these big, huge numbers of months of inventory on the market. So people were foreclosing because their payments were adjusting back then because they were on adjustable mortgages. A lot of people were on adjustables and they couldn't make their payments. Back then, there were 1.7 million foreclosures, and right now there's like 300,000. Things are vastly different, not to mention, y'all, that lending standards have improved. We're not doing those squirrely loans anymore. I mean, sure, granted, there's a small percentage of loans that like bank statements and P&L loans, and you can kind of do some hybrid loans with some alternate paperwork, but it's not rampant. It's a very small percentage and it's strict. Like there's some restrictions that make it a lot more strict than it used to be way back then. So that's what we mean when we say things are different. Foreclosure activity has actually decreased. Like look at the far right of this graph, y'all. Foreclosures are not rampant. Like they're just not. Like the percent of them are low. Now, I will tell you, I believe that they're going to uptick a little bit because home insurance and home taxes are going up. And at some point, there's some people that aren't going to be able to pay their mortgage. Foreclosures are the part of any healthy market. Okay. There always and always have been in the 29 years I've been doing this. There have always been foreclosures. Right now, it's a lot less. And a lot of people, instead of foreclosing, they've got equity in their house and they're like, well, let me go ahead and put it on the market super quick and see if I can do that. Now, if they can sell it in a couple of months and avoid the foreclosure, they're doing that. If not, they're going to foreclose, right? But the market is so far doing a pretty good job of gobbling up these foreclosures. I really want to hear your comments about this. If you're still in the belief that you think that the housing bubble is coming, I'd actually love to hear about it. We could talk offline, get a call, because I'm always doing some research. I'm always wanting to hear what people think so I can make good videos for y'all to make good decisions. But as of right now, I am of the professional opinion that in the near future, so in mortgage lending, the near future means the next year, foreclosures are not going to dominate our market like they did back in 2008. So I don't think that's going to happen. But let's talk about the economy, where we are. So this is all setting the stage. We're almost getting to the predictions. So I think we all know this by now, unless you've been, living in a rock, that we are going to be a Republican regime for the next 4 years. Now, what that means, uncertainty of the election is over. That was causing a lot of weirdness in the summer months of like everyone like, what's going to happen? Republicans are historically pro-business and pro-profit. So this is where a lot of the legislation is coming. So when this happened, actually the day after the election, the mortgage interest rates went up. So we're going to talk about the market really quick and how this all matters with mortgage rates. So mortgage rates are closely resembled to the 10-year Treasury. And so when the stocks are doing really good and the economy's really good and things are growing and employment is up and all those things, that is generally bad for mortgage rates. It usually means that mortgage rates are up, okay? Because the investors that keep this economy going by buying and selling things, they say, ooh, we're going to take our money from the bond market where our returns are stable. Like you don't make a lot of money on bonds. Those are fixed interest, okay? We're going to take our money from here and we're going to go buy us some stocks because the stock market is kicking it over here. We're just going to go put our money over there and make more returns. And so when there's a lack of money in the bond market, the prices go down and the yields go up. The yields go up. They're trying to attract, like, hey, we want you guys back over here. Let's attract you with some higher rates of return so that you come back over to the bond market. That's kind of in a nutshell how the economics of all that works. Okay. So that's how it works. So have you bought any stocks lately? I know my husband's been glued to E-Trade. Fernando, if you're watching, he's been glued to E-Trade because he's buying stocks. I mean, that's exactly what investors do. Whether you're a little investor or a big investor, the psychology is the same about the stocks. So, so let's look at, I've got actually a graph for you here. So the mortgage interest rates most closely resemble the 10-year Treasury. So you can see here that as the Treasury has gone up and down, the mortgage rates are almost exactly in tandem. Up, down, up, down. They are just like a mirror of each other. So if you're wanting to wonder what mortgage rates are doing, this is the place to look. Just go on the internet and search for 10-year Treasury, and that's going to give you an idea. Okay, so that's your big hint for today. That's what you're going to get if you're out there looking. So we're getting closer to the predictions. I want to talk about the Fed because this is very much linked to what's going on. In fact, we have a Fed tomorrow. We have a Fed release, and there is a like 82 to 90% chance that they are going to decrease the federal funds rate by 0.25%. So this is news that is no surprise. It's already priced into the market. Okay, so I don't expect any movements in mortgage tomorrow based on that fact because we all pretty much know it, what's going on. Now, if that doesn't happen, that's a different story. If the Fed surprises us and that doesn't happen, but it's a very small percent. So the Fed is not a government entity. They're a separate entity, and they are there to keep watch, kind of be a watchdog of the U.S. government and do policy around the rates so that things don't get out of control, and it just kind of helps the money supply. That's what they're there to do. So their big thing that they look at is CPI, which is the core price index. And the core price index is a big indicator of inflation. And they want inflation to be 2%. That is the goal. Back in 2021, when things got out of control, it was over 4%. So we've come a long way, okay? Because of recently, it's about 2.8% right now. So it's making it there, but it's not quite there yet. So I'm going to show you here. Okay. So consumer price index, you can see, yeah, it's actually 2.7. And then they've got another number that they call adjusted for energy and whatever. That's all very complicated. So we're not going to go into that. But bottom line is it's trending in the right direction. Okay. So this is how you can see the U.S. Consumer Price Index. And these are numbers as of just last month. Tomorrow, rates are going to go down 0.25. And it's really interesting because normally with the way that the market is, inflation's still a little bit high and wages are going up. Usually you don't cut interest rates, but the Fed has an agenda and they're like, hey, we want to cut them. So I think what I'm hearing now in the economic stuff that I look into, they're going to slowly trickle down. That's a hint into the projection is that yes, things are going down, but they're not going to be a nosedive. The only way that things would nosedive, y'all, is if the government was rescuing us from something. They were rescuing us from COVID. They were rescuing us from bank failures in 2008. And then years before, I can tell you in 2001, 2002, when there was another really big dip, they were rescuing us from something else. So rescue and bad news is what makes the interest rates nosedive. Now, we don't see any of that coming, but we never do. It's always a surprise. In this narrative, now the question is, what are rates going to do? What's the Fed going to do with the federal funds rate in January? That is the next committee meeting, January 29th, after December. There's a very high chance, like 82% chance, that the Fed is going to actually stay the same. That's what it's predicted to do. I hear every day, oh, hey, the Fed lowered the rates. That must mean that my rate is lower too. Actually, that's what I want to talk to you about next, because I want to teach you how to understand what you hear in the news and make the right decisions for you when the time comes. Actually, mortgage rates and the Fed funds rate that the Fed talks about are not the same. And so the federal funds rate is the rate at which companies, banks, big institutions borrow money from the federal government overnight to cover. It's like trying to avoid bouncing a check. That's exactly what it is. They're like, ooh, we had this much money and this many depositors want withdrawals, and we only have so much money laying around. We only have 200 million laying around in the vault, but 300 million wanted their money. So they had a deficit of 100 million. This is an example. So they sweep it from an account, line of credit, whatever, and they get it at the rate of whatever this federal funds rate is. That's literally what that is. That's not the mortgage rates. But all of that influences, I'm not to say that it doesn't influence mortgage rates, because it's influencing the bond and the stock market and how they're reacting to things and how they're reacting to things. And we talked about before on the 10-year Treasury, that is what affects mortgage rates. So it's indirect, but it's kind of similar. As you can see, there's a big gap between the top line. The top red line is the average 30-year fixed rate over time. This goes back to 2007. From 2007 to 2023 is the span of this. And you can see the federal funds rate down at the very bottom. Now, sometimes they go down at the same time and sometimes they go up at the same time, but there's been lots of times where it's been totally flat and rates are still happening all the time. So just this visual, I'm hoping, helps you to understand. Are you ready for the predictions, the crystal ball? Enough of all this other stuff. What is going to happen? We got to get stuff done and start moving on with our lives. We need to know if we're going to stop wasting money on rent and if we're going to buy this year. Right now in December, and this is an average, y'all. Some people are getting lower rates than this and some people are getting a little bit higher. That's what averages mean. So you can see here these columns. Fannie Mae, that's where the conventional loans sit. MBA's Mortgage Bankers Association, and then Wells Fargo came out with some predictions. They're one of the largest banks in the US, so they're pretty important. So all these predictions came out, and on the far right is the average of all three. So high sixes, mid sixes, low sixes through the rest of the year. I've heard in some other, now these are averages. So will there be some higher rates? Maybe. And will there be some lower rates? Maybe. So we don't know what the swing is going to be. I've heard that kind of the high fives to the high sixes is going to be the swing. Now, really, nobody knows. All we can do is look at historical data and start to forecast. And this is what has come out. Let's talk about home values and home prices, because that's the big affordability gap between rates and home prices. That's what's keeping monthly payments up to keep buyers from moving forward. It's all about that, y'all. Now, these are national forecasts. Existing home sales, and this is National Association of Realtors, and they go and get all this information from all these different places. Now, it's a little bit of a swing. Home sales are going to go up from 7 to 12%, which is an increase. That means things are going to keep moving. Existing home sales going to go up this year and next year. So this year meaning 2025. We're almost in 2025 and 2026. New home sales are going to go up quite a bit. I know I live in Texas. I live in Houston, and the builders are cranking it all out. Lots of new homes here. Median home prices are going to go up average 2% forecasted. So I want you to remember this is a forecast for national. There are pockets that will go up higher than this. I live in Texas. I can just tell you it's going to go up higher. It just is. We have no state tax. We are pretty economical to live. So people come to our state. Mortgage rates in the sixes. Job gains, about 2 million. Job gains are what keep the economy going because people are employed and they can pay for goods and services. That's the whole name of the game. What I want to let you know, I'm going to actually recap all this for you. It's going to be pretty much more of the same. But what I am reading between the lines is that homes have stopped growing so much so that people can afford them. Now, that doesn't mean that homes are going to go backwards and miraculously your house payments are going to drop this gigantic amount. That is one thing that we need to be concerned about. So people need to make more money. So you need to stay at your job or go to a job that pays more money. Some people are getting second jobs so that they can make ends meet, make more money, and therefore afford more of a payment. You can also cut costs, y'all. There's a lot of people that waste a lot of money on a lot of things. I am one that is guilty of that. I mean, just the apps on my phone, the service for this, the service for that. My kids, I don't know, they wanted to get unlimited Spotify and I wouldn't let them. I was like, heck no, we're not getting that for whatever that costs, right? So that is how it works. You need to cut money or you need to make more. That's how we're going to do this affordability gap thing. Everybody, the politicians, me, we want you to make more money and get higher wages so that you can pay for more things. I'm going to give y'all a recap right now. Consumer debt is at an all-time high. More than half Americans have 4% or lower rate. Prices are going to continue to rise, not ginormous, but they're going to continue to rise. And a lot of Americans, 2/3 of Americans, y'all, own their house with more than 50% equity. This is going to help people transfer the wealth to a new home. It just is, even if it's at 6% or 7%. Foreclosure rates remain low. Inventory is low, but stabilizing. Goods and services are rising. I just love this guy and I had to show him. So get off the can, y'all. Like if you need to move and get on with y'all's life, just do it. I mean, we have been waiting around and I think in general, what you need to understand is that rates are not going to nosedive. Values are not going to nosedive. So we need to all regroup and recalibrate. And remember that slide that I showed you about the equity and that homeowners have so much more wealth than renters? That is what needs to be seared in your mind as you're thinking, do I enter into the market? Thank you so much for your attention today. I really appreciate it. Let me hear your questions. Keep tuning in. Talk to you soon.